Well, folks, is Nvidia in a complete bubble? This video is inspired by this chart right here. Nvidia, since May of 2016, overlaid on top of Cisco stock since the IPO of America Online. Who remembers that one? You got mail. Anyway, from February 92, which was basically right after I was born. Jan 92 here. Anyway, so they overlaid Nvidia since 2016 over here as the green line, over Cisco since 92. And there's this eerie, similar pattern here that suggests maybe there's a giant collapse coming for Nvidia. Now, do keep in mind, it looks like this this over here on the left is increasing at levels of basically 2,000. So having a little hard time understanding exactly how to line this up. But if I take this level here and I compare that chart to where Cisco was, maybe it means we have another 10% to go, 1,300 or so based on this chart. But it basically suggests we're getting relatively close to the top. Now, is that fair? Is it fair to compare Cisco to Nvidia today? So what I decided to do was go into the 2000 earnings report for Cisco and make some comparisons. This comes, though, at the same time as the market ear put this piece together, which we made some notes on over at ehack.com. But basically, the charts to pay attention to are ones like these right here. U.S. valuations in the blue line, specifically tech, media, and telecom PE ratios relative to everything without tech, media, and telecom. In other words, PE ratios are being driven by tech, media, and telecom. This makes sense, and it was unfortunately the same thing that you saw in the 2000 bubble over here, and then a stimulus bubble over here, which is not great. It's also worth noting that Microsoft, Nvidia, Alphabet, Amazon, and Apple make up 27% of the S&P 500 right now, which is pretty substantial. That means of the S&P 500, 25% of the total income of the entire index of 500 stocks is made up by just 7 companies. Here are those 7 companies. Largest contributors to fourth quarter net income: Apple, Microsoft, Exxon, Alphabet, Chase, Chevron, Bank of America. It's a percentage of the total profit here. When you add these up, you get 25% of earnings in S&P 500 companies altogether, all 500. 25% being led by just 7 of them. Obviously, Apple, Microsoft, Alphabet being some of the big tech portions of that. Although tech earnings continue to get forecast as higher, so it does make folks wonder, well, I mean, maybe it's not a bubble because that's just where all the earnings are today. And so exactly that thesis is why I decided, you know what? Excuse me. Let's hop on over to the Cisco earnings statement from 2000, which is kind of remarkable. So let's go through this. This is probably one of the older annual reports I've gone through this year. I do like looking at historical data. I love going through stuff from the 80s, but usually I'm looking at like Fed minutes and that. This is interesting though, all right? So here's some things to note. The first thing that I wanted to do was I wanted to look at how many times sales this company is selling for in 1998, 1999, and 2000. And in these various years, it was selling for 16.9 times sales at peak, 8.4 times sales the year before peak, and 5 times sales 2 years before its peak. It had gross margins in a range that did move up substantially, from 42% to 53% to 64%. Nvidia is sitting around 77% gross margins, which means they make a lot of money, right? And then on a net income basis, we had margins move up to a high of about 26.5% over at Cisco. Now, what's interesting about that is if you jump on over to Nvidia's investor relations and you get their latest annual report, you'll be able to compare these numbers directly. Now, I already did that, and I just want you to at least see one of them in one of their latest annual reports so that you can compare it yourself and see the comparison. But when you go to the annual report, you're going to notice some differences if you know what to look for. And those are the things we want to compare and understand, as well as what's similar, because then we'll be able to get some good information in terms of, okay, all right, is this Cisco 2.0? Anyway, so we go over here to the revenue statement for calendar 2023, which is basically January 28th, my birthday, 2023, through January 8th, 2024. You'll find here that their net margin is closer to about %. So in other words, Nvidia has about twice the net income percentage as Cisco did at peak for Cisco. So Nvidia is definitely bringing more money to the bottom line. One of the easiest ways to see that is in the earnings per share measure. Look right here. Earnings per share at Cisco, we're sitting at just 36 cents, 29 cents, or 20 cents on a GAAP basis, which means the company was trading for 221 times earnings at peak. Well, look at the earnings per share at Nvidia. Earnings per share at Nvidia exploded to $12 per share in 2024, which is very, very high. They are actually printing substantial cash, $29 billion in net income. Okay, so what other comparisons can we make? How can we make some direct comparisons between the companies? Well, I went ahead and wrote those all out right here. Let's go through them to make it nice and simple for you. So, Nvidia calendar 2023. You have a company that has about $60.9 billion of revenue. And at $481 per share at the end of the year, it was about a $1.18 trillion company. It was trading for 19 times sales. That's actually more than the sales multiple you had at the Cisco peak of, sorry, not that, it's this number right here, 16.9 times sales. So you're definitely trading for more on a sales basis than Cisco ever has. But the earnings are so strong that Cisco at peak was trading for somewhere around 221 to 150 times earnings, depending on if you use the GAAP EPS or the non-GAAP, the adjusted EPS. Well, on an adjusted EPS basis, Nvidia is trading for just 27 times, substantially lower valuation. For the year 2024, Nvidia is expected to sell for a record 23.8 times sales. That's huge. That's almost 50% more than Cisco ever sold for. But on a per share earnings valuation, they're expected to only be trading for 43 times 2024 earnings on an adjusted basis. That's not bad. So what I tried to do then is align this a little bit differently. What if I divide the company's growth rates that are forecast over the next 4 years, or in the case of Cisco, what growth they actually had over the next 4 years, to try to get a PEG ratio. And so what I got with Nvidia's forecast growth of just 10% on average for earnings per share growth over the next 4 years, I actually get a PEG ratio of about 4. This includes one negative year. And that's simple. 43 divided by 10 is about 4.3, right? From 2000 on, Cisco's EPS for the next 4 years grew at about 11%. And if you use their adjusted 150 PE ratio, that means their PEG ratio was about 15. So if we use PEG ratios, Nvidia is roughly 4 times cheaper than Cisco was at peak. Bottom line, Nvidia makes a whole lot more money than Cisco did on a per share basis in 2000. So yes, does it feel bubbly? Absolutely. Now, obviously, we are comparing what happened with Cisco to what hopefully happens with Nvidia, which is forecast growth. What happens if Nvidia's growth collapses? well, then the Cisco story could play out. The Cisco story that we saw with that chart coming way back down and Cisco stock collapsing from a peak of $79 all the way to $10. Worth noting what that kind of decline is. That's an 89% decline. And then it sort of grew from there. What happened? Well, growth substantially slowed despite people's expectations that growth would go on forever. And the question is, could that happen to Nvidia stock? Look at the actual stock movement. Euphoria bubbled up to $79. So from then, if you invested at peak, you would still be down 40% on your investment. But if you just waited a mere 11 months, maybe 12 months, you could have bought the stock for somewhere around $13 to $10. Let's say you bought it at $13 a share. Today, you'd still be up 247%. So, as usual, timing is everything. But obviously, there's a valuation similarity here in that Nvidia on a per sales basis feels grossly overvalued. But then again, today, we tend to find a more reliable indicator is a PEG ratio. How many times earnings growth are we paying for the company? And the closer you can get to a 1 PEG, the better deal it seems to be. In fact, if you look at Cisco when it hit its low in October 2022 at $10.53 after the boom, you were trading with an adjusted EPS of 38 cents, with future growth expected to be about 28%, which meant you were basically at a 1 PEG. So you really want to buy these stocks when they're closer to a 1 PEG. Definitely not when they're at a 15 PEG. And honestly, a 4 PEG for a chip designer, it's getting a little rich. Most manufacturers today trade for around 1.6 to 2 PEG. Software companies, maybe you can call Nvidia that, are going to trade for somewhere between a 2.6 to a 3 PEG. And then we do start getting a little bit rich. And of course, that's where the Nvidia story can collapse. If, quite frankly, Amazon's heads up to the world, which is, hey, we're gonna sit out the H100s and we're gonna wait for the Blackwell chips, starts reverberating through other companies, and everybody starts saying, yeah, we'll wait, and growth collapses or goes negative for Nvidia, then Nvidia's stock valuation will very quickly, almost overnight, mirror that of Cisco's. Consider this for a moment. If Nvidia's stock is only expected to grow by a total of 10% in earnings over the next 4 years, so let's call it 2% compounded. So I'm going to go 1.02 times 1.02 times 1.02 times 1.02 puts us about 8.4. So maybe call it 2.3%. Per year. Yeah, that gets us closer to 10%. 2.3, 2.4% per year over the next few years. That could be 50% next year, negative 10% earnings growth the year thereafter, right? It just all averages out. Well, in that case, you would take a PE ratio of 43 and you would divide it by 2.4 for the average growth rate. That would skyrocket Nvidia's PEG ratio to 18 overnight. And all it would take is not a bad next year, but the next years thereafter having some really big negative earnings years, which could happen if companies decide to delay orders and the valuations of H100s plummet. Because remember, right now, H100s and Blackwells and all of the new chips that Nvidia announces, they're all selling for a substantial premium. I think this is the big red flag that people forget about when it comes to Nvidia, is Nvidia is not always going to sell a $7,500 chip, which is roughly what the stock should, or the H100 should be selling for. Let's write that down so you can see it visually. Nvidia is not always going to be able to say, oh, this is a $7,500 chip, but we're going to sell it to you for $35,000. Remember, Amazon for AWS already delayed the H100s. I'm like, we're good right now. We're good right now. Elon Musk just told us, hey, we're not compute constrained anymore. Why don't you send those chips that are supposed to go to Tesla? I already made a video on that. If you want that update, just meet Kevin Tesla, look it up. I did. I think the title is Meet Kevin Tesla Call Options. Look that up. Elon Tesla, go ahead and send those chips to XAI. What that is doing, this sort of redistribution of H100 orders, is it's going to reduce demand for people paying a premium for those H100s. And that chip price will move down to what it should be. It's MSRP of, frankly, somewhere around $7,500, which might cost Nvidia $3,500 to manufacture. So they could still get their margin. They're just not getting that ridiculous level of margin that they're used to getting now. That is going to continue happening. It's now AWS, and now it's Elon. Who's next to say, I've got enough H100s? Now I know it takes time to set up the install capacity, but the reality is the more companies you get that start saying, we're good on compute. Even Snowflake's like, does anybody want to be acquired? Because we need more customers for AI and we can't find any. It's just in the news today. But anyway, what happens is those margins get squeezed. Then EPS growth will collapse at Nvidia. Then Nvidia's PEG ratio will rapidly increase to look like Cisco's, and then yes, the stock should collapse. Now, I don't think that's imminent, but I do think we're starting to get some red flags. AWS and Elon are the start of those red flags. That's my take. Not saying it can't go euphoric rally over the next 2-3 months, but we walk into an unemployment recession and then companies start cutting these H100 orders or the Blackwell orders. Those margins will collapse, earnings growth will collapse, Nvidia stock will just follow the same path that Cisco stock followed. And yes, the dot-com bubble could actually repeat itself. Hey, if you like this, make sure to subscribe to the channel. Check out my courses on building your wealth at meetkevin.com. Join me in Vegas this month, June 21st to June 23rd. And folks, we'll see you in the next one. Thanks so much. Goodbye.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than HouseHack, nor am I presently acting as a market maker. Make sure if you're considering investing in HouseHack to always read the PPM at househack.com.